Greetings. This information was compiled for the IRS Reddit community and anyone interested in how Major League franchise owners exploit the tax system. The ultra-wealthy buyers of sports franchises have taken advantage of a tax incentive designed to spur business investment. The same almost holds, whether it's a local business sponsoring a little league team or the hundreds of millions a billionaire pays for purchasing a major league franchise. When someone buys a business, they can often deduct almost the entire sale price against their income during the ensuing years. That allows them to pay less taxes by offsetting capital gains tax rates when they sell. The underlying logic is that the purchase price comprised assets, buildings, equipment, patents, and anything that degrades over time. Detractors to sports team owners note that a team's most valuable assets, such as TV deals and player contracts, are virtually guaranteed to regenerate because sports franchises are near monopolies. In the 1940s, a wealthy team owner argued for a second tax deduction for his players beyond salaries. Depreciation. The contracts were treated as separate assets. As an asset, the value assigned to a new owner could be used to offset taxes on team profits. Soon all the other franchise owners followed, and it became standard practice. By the 1970s, several NBA teams claimed that more than 90% of their value consisted of player contracts that could be written off on the owner's taxes. Following lobbying by Major League Baseball, in 2004, sports teams were granted rights to expand this deduction as part of a tax bill signed by George W. Bush, former owner of the Texas Rangers. Now, team owners could write off the price they paid not just for player contracts but also for other items such as TV and radio contracts and even goodwill. Altogether, those assets typically amount to 90% or more of the price paid for a team. In the past 2 decades, the average value of basketball, football, baseball, and hockey teams has grown by more than 500%. Advocates for team owners point out that when owners sell their teams, they have to pay back the taxes they avoided by using amortization, presuming most people don't understand the differences between capital gains and employee wages and their rate differences. Detractors of franchise owner practices call for an end to stepped-up basis loopholes, cite minimal risk, and even if owners repay the taxes they skipped, deferring payment of those taxes for years essentially amounts to an interest-free loan from taxpayers. Owners reap huge gains by investing that money. Also, if owners died while holding their stake, as many do, the tax savings may never be repaid. And their heirs can generally restart the amortization cycle anew. Stadium deals. Franchise owners have found another way to funnel tax dollars: sports stadiums. What makes sports teams unique is that they foster and broadcast a city's collective identity. As social animals, most are enthralled at every chance to participate. Billionaires undoubtedly leverage these inherent social aspects, like any deal for their self-interests, by threatening to move and court offers from other cities. Since 1990, franchises in major North American sports leagues have taken $30 billion worth of taxpayer funds from state and local governments to build stadiums. Sports teams often get big property tax breaks and reimbursements on operating expenses, like utilities and security, on game days. Most deals also let the owners keep the revenue from naming rights, luxury box seats, and concessions like the Atlanta Braves' $150 hamburger. Taxpayers are paying for the homes of their favorite local sports teams. They don't own those homes, except for the Green Bay Packers, and have to buy expensive tickets to visit them. Often, the excuse for spending public money on stadiums is that it will create jobs and boost the local economy. The owners would have us believe that public funding for private stadiums is a public service. One comprehensive study showed that new stadiums did not boost the local economy in many cases. That is not surprising considering that many jobs such facilities provide after the temporary construction jobs are gone are low-wage service jobs. In efforts to offer a fairer playing field, the Biden administration called for a minimum wealth tax on the wealthiest Americans in 2022, calling for a 20% rate that would hit both the income and unrealized capital gains of U.S. households worth more than $100 million, or about 0.01% of Americans.